Hello, and welcome to the first spring edition of the Morgans Edward Street End of Week Wrap for Friday, 1st of September. As we come to the tail end of the reporting season, in a moment Matt will give you a quick summary snapshot. For me though, the notable misses have been punished, although reported earnings have been reasonable. There's certainly been a flattening of consensus forward EPS expectations for ASX 200 industrials, which has meant weaker share prices overall. The industrials PE has derated from 16.7 earlier in 2017 down to 15.8 currently. As always, please note that our comments are general in nature, and please speak to your Edward Street advisor if you wish to know if any of the following stock recommendations suit your personal needs and objectives. I'll now pass over to Matt Gordon for his summary. Matt?
Thanks, Brad. It's been a very busy reporting season as always, which wraps up this week. The results were looking a bit ugly until halfway through the season, where some of the heavyweights even out the scorecard. Unlike prior years where we have seen the beats outnumber the misses by as much as 2-1, this year the scorecard was less flattering, and some would say bordering on disappointing, with the scorecard of beats and misses almost exactly equal. Results that were well received include Blackmores, A2 Milk, Flight Centre, BHP, Medibank and Altium. And the reports that were met with selling included Domino's, BlueScope, QBE, Healthscope and Vocus. Keep in mind there is a bit of short selling activity around a few of these names, which tends to result in higher fluctuations when the verdict is handed down. Research have produced a list of best buys stemming from the recent results, which include Oil Search, Westpac and Apollo Tourism. And your advisor will be able to give you a copy of this list if you ask them nicely. Lastly, it'd be remiss of me not to mention two of the most widely held stocks making headlines recently, being Telstra and CBA. As we all know, markets dislike uncertainty, and these two names are currently in the sin bin. CBA have got themselves in a mess with AUSTRAC due to flaws in their reporting obligations, and Telstra has cut their dividend in support of future growth. The market has differing opinions on these two stocks, but prior history suggests that Telstra is close to its 9% grossed up support at $3.50, and CBA will likely follow the foreign exchange trading scandal that NAB went through a few years ago and be met with less support than usual over the coming months until all issues are resolved. Cheers, Brad.
Thanks, Matt. On my left, we have Tristan Elholm, who will run through his key buy post-reporting season. Tristan?
Thank you, Brad. This week I've been looking at Bapcor Limited, formerly known as Burson Group. This is a company focused on the distribution of automotive aftermarket parts. Bapcor supplies replacement parts and consumables used in the service and repair of vehicles. It also includes the sale of accessories and maintenance products to vehicle owners. BAP operates over 145 auto parts stores across Australia. There are three reasons why I remain a happy buyer of this stock. Firstly, Bapcor reported full year 2017 figures which have proved its ability to maintain its strong growth profile and to build its business. With 36% EPS growth, this exceeded Morgans and consensus figures and in fact managed to beat estimates on every line. We like to invest in businesses with positive momentum, and that is exactly what Bapcor has taken into FY18. Secondly, as part of building its growth profile, Bapcor has proven its ability to make successful acquisitions, as was the case with Hellaby Holdings earlier this year. The CEO described the acquisition as moving like a house on fire and sees further upside in Hellaby's auto by adding to their range and the channels via which they go to market. As part of the acquisition, Bapcor hopes to divest their non-core footwear and resource services businesses by the end of this calendar year. I couldn't mention investment in Bapcor without discussing a small cloud hanging over the space, and that is Amazon. This behemoth of a company has cast uncertainty within the space over the past 12 months. However, I note that approximately 75% of BAP's business is trade-based and that Amazon have no material presence in automotive parts. With Bapcor's business based on range, service, expertise, in-house advice and fitting services, I tend to think that it would be a hard task to replicate. Bapcor is currently priced at $5.58, while Morgans have a $6.19 price target and ad recommendation. On weakness, I would happily buy the stock. Brad.
Thanks, Tristan. We also have a busy week on the corporate action side. Please note that applications and funds are due for Right Crowd, ANZ Capital Notes 5 for reinvestment, and NCP Master Income Trust by the end of next week. If you would like to know more about the latest Magellan Global offer, which kicks off later this month, please contact your advisor. Well, that wraps up another edition. Please feel free to share this video with any of your colleagues or friends, and hop onto Facebook and like the Morgans Edward Street Stockbroking page. Have a great weekend, and we'll see you again next week.